let's focus on net present value. Generally, net present value and internal rate of return are two methods which are based on discounted cash flow analysis. So you've covered time value of money in the previous lecture already, discounting and compounding, and now we start applying these techniques. So we don't just understand the concept, we need to apply them to business decisions. And net present value is probably the most well-known application for discounting process. Generally, net present value simply measures a sum of present values of all project cash flows. Because when you invest money, you have initial outlay. Normally, you spend some money initially at the start of the project, and you start receiving cash inflows later. There might be some additional cash outflows throughout the life of the project. For example, you might need to maintain certain equipment or pay for insurances or invest some additional amount. There might be some negative outlays as well, negative cash flows. But generally, you expect that for the rest of the project, for the duration, for the majority of duration of the project, you will have significant cash inflows, which hopefully should compensate you for your initial investment and generate sufficient profit. The problem is that cash flows generated later are worth less compared to more recent cash inflows. For example, you've invested a certain sum and you expect to receive £10,000 each year for the next 10 years. Apparently 10,000 which you will receive next year is worth more compared to 10,000 which you will obtain in year 9 or 10 in your project, for various reasons which we've covered in previous lectures. And if you have 2 or 3 alternative projects which will have different sets of different streams of cash flows, you are not able to compare them because it's like comparing apples and oranges. Before you will be able to compare and decide which project is better, you need to bring them all to a common denominator. And this common denominator is the net present value. You take all cash flows which the project generates, both in and out, and bring them into today's terms, recalculate them to bring them into today's terms. Then you will be able to compare alternative projects. And generally, there is a very simple investment decision criteria using net present value. If it's positive, you should accept the project because it will increase shareholders' value. If you pursue projects with positive net present value, your wealth will increase. And similarly, if net present value of a project is negative, you should reject it. And if you have a choice between various alternative mutually exclusive projects, you just go for the project with the highest net present value. Very simple idea, right? And now you need to calculate them. And let's have a look how it's done. The official formula might look rather complex, but in fact it's not. It's just a mathematical expression of the idea that we take all cash flows, so have a look, all our terms in numerators, this C0, C1, C2, and so on, Cn, these are our cash flows in different time periods. So all we do, we discount them using an appropriate discount factor, and the discount factor will relate to the time period. For example, here, the first discount factor, the first term in brackets, is raised to power 1 because it's related to period 1. Second discount factor, this denominator in brackets, is raised to power 2 because this is the cash flow from period 2, and so on. So we take all cash flows, discount them using appropriate discount factor, and add them up. So basically, this is the explanation for this formula, or if you prefer a simple explanation, you might remember this formula instead, that net present value is simply a difference between present value of all cash inflows minus present value of all cash outflows. If inflows are greater, this project will generate positive net present value, you should go for it. If cash outflows in present terms are greater, again, net present value will be negative and you should reject this project. That's the theory. And now let's have a look how we apply this. So let's have a look at our exercises. We have an investment of 350,000, which will generate annual cash flows of 78,000 for the next 5 years. So have a look how it will look like on a timeline. This is our timeline. This is the present period, period 0. And in this period, our cash flow is negative. We need to invest 350,000. Then for the next 5 years, our project will generate positive cash flow of 78,000 each year. 78, 78, 78, and 78. If you simply add up these numbers, 78,000 times 5 years, it will appear that your cash inflows are 390,000, which is greater than your initial investment. So this is kind of your, not profit, let's call it revenue. This is your revenue and this is your cost. And it might look like you are generating £40,000 profit. You should be better off as a result of this project. But this would be a very naive and incorrect interpretation of these numbers, because these cash flows, which you are going to receive later in time, are worth significantly less compared to the cash flow which you are going to receive very shortly. This particular calculation ignores time value of money, and that is why it is incorrect. Moreover, if you pay attention to the actual exercise, you can see here that you could be earning 13% in an alternative investment. In other words, during these 5 years, you could be earning 13% on 350,000. Which also represents a significant sum, which you also need to bear in mind. This is the opportunity cost of your investment. And who knows whether this project is worthwhile, considering that you could be earning this amount elsewhere. So we need to calculate this to check which project is actually will be better for you, this one, or simply putting your money in this particular alternative investment, let's say bank account, savings account, which will generate 13%. And in order to do this correctly, we'll need to discount all of these cash flows. So what we are doing, we are going to discount each and every cash flow which we are going to receive in the future and bring them into today's terms. The first cash outlay, 350, all cash flows in thousands. I will not keep writing down all of these zeros. I will just keep the numbers, the thousands. We can discount this if we prefer, using our discount factor, but we would need to raise it to power 0, which relates to our time period. And any term raised to a power 0, any number, any x raised to power 0 is actually unity, which means that our term in the denominator is equal to unity, which actually means that the whole thing is just equal to 350 with a negative sign. So we could just be, for sake of consistency, we could write down all of the cash flows with this discounting factor, but we don't need to discount the first initial outlay. And even if you think about this, we are trying to bring all of these cash flows to present terms. So what we are trying to do, we try to bring them to present. And this first initial cash flow is expressed in present terms already. That is why we don't need to discount it. But if you prefer, you can just write it down for the sake of consistency. And this is what we are doing. We take every single cash flow, there is no space here, so I will just leave it blank. Every single cash flow, discount it using appropriate discount factor, which is raised to a power which relates to the time period. Every single one, right? So this is what you do, and add them up. Add them up, and this will give you your net present value. And this is what we are doing here. This is our appropriate formula. This is exactly what we've done. So our cash inflows are going to be 78,000, each of them. Our interest rate, our discount factor rate is 13%. Our initial cash outlay is 350 with a negative sign. If we plug all of this in, we will get this particular expression, this one, if you can see here. Right? So 78,000 divided by our appropriate discounting factors, which will generate these particular cash inflows. Cash outflows are just 350,000. So for simplicity, we've calculated them separately. If it's just easier for you, you can add up positive numbers, add up negative numbers, and then compare. As you can see here, cash inflows are less in present terms compared to the cash outflows. In other words, we spent £350,000 to purchase this stream of cash flows, which is only worth 288,000. We've overspent on this project. It does not generate enough cash to be worthwhile, because all of these future streams of cash flows are only worth 288,000 in present term, and we've spent 350. The price is greater than what you will get in return. So that is why it's not worthwhile. The difference between present value of cash inflows and cash outflows is negative. Net present value here is negative, which means that we should not invest in this particular project. It should not be undertaken because our wealth will go down by 61,000. But please pay attention. Here we are talking about the opportunity costs. It doesn't mean that you will lose 61,000, that your bank balance will go down by 61,000. No, here we are talking about the opportunity cost. You are 61,000 pounds worse off compared to the next best alternative. So if you've invested elsewhere, you would earn 13%, and this would leave you with a capital and balance would be greater than this balance by 61,000. You would be 61,000 pounds better off in an alternative investment compared to this one. And pay attention, this present value, 61,000, with a negative sign, the purple number, has nothing to do with the actual profit we've tried to calculate initially. If you recall, costs are 350 and in monetary terms our revenue is 390. So it looks like the profit, the accounting profit in accounting terms is 40,000. But in reality, we should still not pursue this because this profit is 61,000 pounds less compared to what we would generate in an alternative investment. This project is worse from the opportunity cost point of view, which is the correct way to approach this. You are better off elsewhere. You are 61,000 pounds worse off. That's why you should not go for it. Net present value is great because one of the advantages of this metric is that it gives you a direct measure of how your wealth will increase or reduce as a result of your decision or as a result of certain investment, right? So in this case, if you go for it, you are 61,000 worse off. Okay? That's an idea, that's an approach, that's how you calculate this. Any questions? Are you comfortable with it? Yeah? Simply discount each cash flow. This is what you've done in the previous lecture, this is what you've done in the previous test. But previously you've been asked to discount one cash flow, now you discount all of them. All cash flows are rising throughout the project. And that's it, and add them up, and it's not difficult. If it happens to be positive, invest. If it's negative, don't invest. That's all. Next question, question 9. Let's have a look at this one. Very practical. The whole concept is very applicable to real life. And in reality, this is how businesses make decisions. In economics, when we've studied the profit maximization idea, and I taught you that in order to maximize profit, the company must choose a level of output where marginal revenue equals to marginal cost. This is not how firms in reality make production decisions. In reality, it's done in a slightly simpler manner. So this is rather theoretical concept, which would generate maximum profit. But this is not how it's done in real life. With net present value, it is how firms make decisions in reality. And it's used both in economics, in finance, in accounting, in a variety of disciplines. This is how it's done in practice, and this is how various projects are analyzed or appraised. In public finance, government decisions regarding provision of various services, net present value of a project is always calculated. Okay, so let's have a look at the next question. Cafe Pot Coffee can purchase a new coffee machine for £10,000. The company accountant estimates that the machine will contribute £2,500 per annum for profits for 5 years, and after this it can be scrapped for 500. Now we introduce the idea of scrap value. We've done this when we've calculated accounting rate of return, so previous part of this seminar. Scrap value. The thing is, this is quite frequent and quite common in reality. You buy a certain equipment, especially with physical equipment. You use them for a certain period of time and then you can get rid of them, and usually there should be some scrap value. It can be resold as a second-hand machine or just for scrap. It will generate an additional revenue for the company. So in this particular case, the scrap value is 500. Cost of capital is 5%. So let's have a look whether we should proceed with this project or not. So these are our data. What we need to do, we need to lay out our cash flows first of all. In year 0, we have an investment of £10,000. This is the cash outlay, negative cash flow. Then the project will generate £2,500 each year for the next 5 years. This is the life of the project. Please pay attention that the final cash inflow is 3,000 rather than 2.5. This is because it also includes the scrap value. So 2.5 of normal profit, normal contribution to profit, plus £500 from selling this machine for scrap metal possibly, which makes it 3,000. Here we are using this structured technique to calculate net present value. So in this previous exercise, we've written down the formula, and it's not necessarily always convenient. Very frequently you will be using Excel, which is much better and much easier. So you will lay out your cash flows in a structured form, and this is what I would recommend. Just create a table, it makes it much easier to adapt. For example, you have columns for various cash flows occurring in each year. For example, maintenance, labor, insurances, raw materials, or whatever, add them up together to calculate the total annual cash flow, and then you discount the total. It's much easier and quicker. Just columns for various cash flows and the combined cash flow. Next, we are using a relevant discount factor. To get these numbers, I recommend that you use your financial tables. Let me show you where you can find them in your module. We've practiced doing them in our previous seminar, and I've placed them in various places in Moodle. This is where you can find them. So if you go to Moodle, where the resources, textbooks and other resources are located, so this particular section, textbooks, recommended text for both economics and finance parts, video channel for our particular module, links to ebooks, seminar workbooks, and this is where I've placed time value tables. This is the first place where you can find them. Apart from this, they are also available in week 9, where we've studied time value of money, where we've had our lectures, video lectures and presentation slides, where we've studied compounding and discounting. This is where they are, time value tables. And I've also placed them in a seminar where we've done exercises on time value of money. So you can find them in various places, and I do encourage you to learn how to use them, because it will save you a lot of time in the future. You won't need to compound or discount various cash flows all the time. Just get the relevant discount or compound factor and multiply your cash flow by it. But please pay attention. There are various tables here: future value, present value, values of annuities. Make sure that you use the correct one. So in this particular case, we are calculating the present value. We are discounting. So that is why you use table 2. And we know that our discount factor is how many percent? 5%. Have a look. This is the relevant cost of capital. This is our discount rate. So that is why we are going to use this particular column, 5%. This is what we need. Let me just take a screenshot. These are numbers which we need for 5%. I will only copy them. Always keep these financial tables by your side, especially when you will do your exam. And now have a look. These are our discount factors. You can see here that, for example, for the first year, we're using this discount factor. It's that one. For the second year, we are using that discount factor. This is where these numbers are coming from, and so on. So just use the relevant discount factor from the table, just to simplify your calculations. The first cash outlay in period 0 is not discounted, so it will remain as minus 10,000. And then you simply apply this discount factor and multiply your relevant cash flow by this specific multiple. And this will give you your present value. What you have to do next, you just add up all of these numbers. So net present value is simply a sum of all of these cash flows, both in and outflows. Right? This is our net present value, and I saw this number somewhere. One of you have managed to get this number correct. Was it you? Yes, 1200, absolutely correct. This is the present value. This is our solution. Right? And next, because this is positive, it implies that we should go ahead with this particular project. It will increase our wealth by £1,200 compared to an alternative investment. It will not increase necessarily our bank account by this amount, but it will make us better off compared to our next best alternative. The best thing we can do is invest at the bank account at 5%. But this project will make us wealthier. That is why we should go ahead. It's preferable, right? This investment is worthwhile. Got the idea? Here, by the way, please pay attention. We mentioned the cost of capital rather than discount rate. And this is the subject of this week's lecture. In this lecture, in this particular week, this topic is the source of finance and cost of capital. And in this lecture, I explain why cost of capital and discount rate and the required rate of return are the same thing when we calculate net present value. For investment appraisal purposes, the cost of capital and the discount rates are the same thing. This is what I explain in this lecture. Please make sure that you watch it, because it will also be included in your exam. Okay, any questions at this stage? Are you okay? Yes, please. Yes. In any case, you can use the formula or tables, whatever is easier for you. They will give you the same result. It just saves you time from multiplying these terms in brackets and raising them to relevant power. So instead of, let me just give you an example. You can use any of the methods. So what we could have done here, we could have written it in this form. You discount it in this way using power 0, which will be equal to just minus 10,000. Plus, your first cash flow is 2,500, and actually all other cash flows are 2,500. You do it 5 times. So this is year 1, year 2, year 3, year 4, and year 5. And you discount each of them, each of these cash flows, using the same interest rate, cost of capital, discount rate, 5%. But you need to raise all of these denominators to a relevant power. So here it will be power 1, power 2, power 3, power 4, and power 5, right? And if you do this, you will actually, each term will give you these numbers. So it will be equal to 2381, 2268, 2160, 257, 2351. You add them up and you will get the same number. So for example, if you look at this particular term, you could have written it in this way, which we've done, or you could have written it in this way, right? Do you see this? So these two terms are the same thing, right? So you could divide 2,500 by this denominator, by this one, or you could multiply 2,500 times 1 divided by this denominator. It's the same thing, right? But the good thing is that you can find this multiple in a table. This is what the factors in a table are. This is what they are. And it's actually equal to, if you do this, it will be equal to this particular number. So if you want, let's check calculator. So we take 1 and divide by 105. And this will be the result of this. I just write it down. 2,500 times 0.95, 238. 238. This is what we've calculated, right? And this is what we've got here. This is the number. 0.95238. It's been calculated already, so it's just easy. It saves us time from raising everything to relevant power. We just get these multiples straight away and multiply. It's just quicker. It saves us from doing one operation, right? If you don't want to use the tables, that's fine, but it's just convenient. You know, it's just a little bit less operations, and it's simpler, but the result will be absolutely the same. If you prefer to just use the formula if it's clearer for you. Whatever method you choose, follow it and you will be fine, as long as you follow the correct procedure, and you'll be okay. Okay, any other questions? No? Let's do the next exercise, where we apply net present value to 3 projects. We calculate it for 3 projects and compare them. So we apply this metric in order to make an investment decision, basically, to decide whether a particular project is better than any others. So we have 3 potential investment projects. Cost of capital here is 10%, right? Which project should be selected? As before, 3 projects. If you don't have them in a table format, write them down in a table format. It will be easier for you. If there is no period 0, add it up again at the top. Again, it will be simpler for you. If, for example, you have a table which lays out cash flows, make sure that this table includes the initial cash outlay, that it's not forgotten. It could be mentioned in this scenario somewhere else. It might not be appearing in the table straight away, but make sure that you include this. Again, it will be simpler. So here, 3 projects, all of them require £5,000 initial outlay, initial cost. They will generate different cash flows. Project A will have equal cash flows for 7 years. Project B will have the majority of money coming towards the end, while Project C will do the opposite. The money will be coming in the beginning. Which one is better? Who knows? We cannot say straight away. We might guess that possibly this project is preferable, Project C, but we don't know. So let's check. Because our cost of capital is 10%, we'll need to apply the relevant discount factor at 10%, and it's just easier to go to the table straight away. So in this case, we're using this particular column, 10% column. So let me just copy it for you to demonstrate how it's done. You just write them down somewhere or select them. So these are our relevant factors, present value factors, discount factors. We will only need 7 years. but I'll just copy the first bit, put it there to the side so that you can see that this is where the numbers are coming from. This is where I got them from. And now you will be able to see that the first discount factor is always unity for period 0 because we don't discount anything. But the rest, you can see that this one, for example, is equal to first year discount factor. Last one for 7 years, it's this one. So this is where the numbers are coming from, right? Get the numbers for discount factors from the table, and then as before, you simply multiply project cash flow for relevant period, cash flow 1, cash flow 2, cash flow 3, etc., cash flow 7, and add them up. Sum of these cash flows will be equal to net present value. So this will be the present value of cash flow 1, present value of cash flow 2, etc., present value of cash flow 7. This is what we've done for each of the projects. So these are present values of each cash flow for each year for each of the projects. Then we add them up, which will give us the net present value. This is our final row in this table. And this is how the numbers were obtained. Got the idea? Just to illustrate, let's take, for example, this number, this discount factor, and this is going to be present value of project A. Let me just demonstrate you this so that you can see where it's coming from. So our cash flow is 1,100, just to illustrate, times the relevant discount factor is 0.75, 0.75131 multiplied. It's going to be 826.44. This is what we have here. This is the present value of cash flow A, cash flow for project A. Let's take, for example, this one. This cash flow for project B, we apply the relevant discount factor for this period, for period 6, and this should be equal to this particular number. So if we multiply it, it's going to be equal to this. We've multiplied that, and it's equal to that. Right? So let's check with the gray numbers. 1,300, this is the cash flow, this cash flow. We need to multiply it by this factor, 0.56 times 0.56, 447. And this is equal to 733.81. So I've just written on top of it 81. This is where the numbers are coming from. This is how it's been done. Okay, we've done this for all cash flows for all 3 projects, repeated 3 times, and then we simply added them together. So for example, this number is a sum of all of these cash flows. This number is a sum of these cash flows, etc. for all 3 projects. This is net present value. And after we've got these numbers, this is all we need. We just analyze these 3 numbers and nothing else. We are not concerned about the timing of other cash flows, how much each project generates in each year, how much it costs. We are only looking at the final figure. And it's very easy to see here that they're all positive, which is great, which means that all projects are worthwhile. We could select any of them, and it's better than a return from any alternative investment. Our cost of capital is 10%, which implies that the best thing which we can do, our normal profit elsewhere in an alternative investment, is 10%. But any of these projects will generate us a high amount. In other words, they will generate us 10% plus these numbers. So they will generate us more. They will make us better off by these amounts. So if we can afford to go for all 3 of the projects, we should do all 3. Because all of them will increase our wealth. They're all worthwhile. We will become richer as a result of each of these projects. If you can, go for all of them. If not, if you can only afford one, go for the one with the highest cash flow, which is 620, which is project B. So this was A, this was B, this was C. If you can afford 2 projects, because each of them require £5,000 investment, you have 5,000, go for B. You have 10,000, go for B, then A. If you have 15,000, go for all 3. Okay? That's the idea. This is how you use net present value in order to compare alternative projects in investment appraisal, in order to decide whether a project is worthwhile and which one is preferable. Very simple idea and very powerful and very applicable to real life. In your professional practice, you will have to do it. You need to be aware of this, and it's how it's done. So just get used to it. And it's not difficult in reality. As long as you're comfortable with the idea of discounting, you just discount different cash flows and add them up. That's all. The only trick is to select the relevant discount factor to ensure that you use the correct discounting ratios. That's all. Discounting factors.